and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. I'm joined today by Jason Thomas, Head of Global Research and Investment Strategy at Carlyle. Jason, welcome back to Insights.
Thanks for having me back.
So, the Fed cut rates finally in September. What is your view on the macroeconomic impact we've seen so far from that cut?
Well, thus far, of course, you've seen rates markets anticipate more coming. So the Fed only cut rates by 50 basis points, but we have seen peak to trough at 150 basis point decline in 3-year swap rates. We've seen mortgage interest rates, 30-year fixed mortgage interest rates fall by nearly 200 basis points. And of course, in liquid single B bonds, you have financing costs for corporates that have fallen by about 300 basis points. So this is a situation where the Fed has got a lot of bang for its buck. By leaning in to market expectations for more cuts with 50 rather than 25, they've really delivered a lot more effective easing in the economy than you would have expected from the increment of the rate cut itself.
So my day job is to invest in the private credit markets. How does private credit usually perform in a time of cutting rates?
Well, the first thing I would say right now is this is very unusual to see the Fed cutting rates while default rates are low and have actually been trending downward. If you look back over the last 40 years, the Fed generally starts cutting rates when default rates are either elevated or seem to be rising precipitously. So this is an unusual circumstance. I think we should just say, first of all. But in general, when you think about corporate borrowers or borrowers of any kind that have floating rate obligations, this makes it easier for them to service their debt. So this is generally, again, why you have this correspondence with rate cuts and higher default rates. It's generally the Fed sensing that they need to make those financing burdens a little bit lighter. So right now, that's the first effect, that you should have lower defaults because you have lower borrowing costs effectively for the borrowers. The second effect that you see very regularly through history and across markets is that spreads widen. And that's one of those things you can say almost always and everywhere occurs. But the range of spread widening depends on circumstances. And in general, what we see is a confidence band between spread widening that either is about 50% of the decline in base rates or as much as twice. So right in the middle of that range would be suggesting that the spread widening will effectively cancel out the decline in base rates, leaving the total return roughly unchanged.
So Jason, we recently had a very strong jobs report and inflation report. How do you think that impacts the likelihood of Fed cuts for the rest of the year?
Well, I think I would first say that we've been skeptical that the Fed was really going to cut rates as much as had been implied by the futures curve. At a time, it was over 10 rate cuts that were fully priced into markets. And in some ways, these data confirm those views. First of all, the jobs report, not only did you have payrolls that far surpassed expectations, but you also had a decline in the unemployment rate. And also the unemployment rate declined relative to the amount of open but unfilled positions in the economy. In the past, that had generally exercised upward pressure on wages. And in fact, we did see annual wage growth in September of 4%, which matched a 5-month high. Then the inflation data also proved a bit hotter than expected over the course of the month of September. And if you look at core CPI and you exclude shelter, which is lagged and can be distortionary to the data, inflation was up 0.4%, which means almost 5% on an annualized basis. So again, I think that this is changing attitudes. Instead of thinking about how low base rates are going to go, I think people are going to start asking questions of how much more can the Fed really cut from here?
So there's been a lot of debate about what the right real neutral rate is. Put yourself in the position of the Fed. Where do you think that really should be?
If I were advising the Fed, and I do on an occasional basis, I would say that if you don't know the destination, you should proceed very cautiously, go slowly. And I think that when you look at the summary of economic projections, where the Fed on a quarterly basis provides its estimate for where rates are going, where the economy is going, you see that the surveyed board members and presidents of the regional banks are really not sure at all about where the neutral rate is. You have this almost a uniform distribution from Some suggesting that the terminal Fed funds rate will be 2.5%, others saying it's more like 4%. So, in general, I think that again, there should be some caution. My own view is that when you have budget deficits that are 6.5% of GDP at full employment, that means that you have a treasury that's injecting enormous amounts of liquidity into the economy. And the central bank has to be reactive to that, keeping rates somewhat higher as long as the fiscal situation is the way it is. And then in addition, I do think just the demand for capital. I mean, ultimately an interest rate, a real interest rate, is just the price that clears economy-wide savings and investment markets. So as demand for capital picks up because of energy transition, because of this insatiable demand for data centers, you would suspect that the real interest rate, the neutral rate, is going to be somewhat higher as a result. So we had a decade where the neutral rate seemed to very clearly be in negative territory. And now it looks like we have a neutral rate that's certainly over 1% in real terms and perhaps 2%.
Jason, always appreciate your insights. Thanks for joining us. Thanks to all of you for joining us on Insights from the PM's Desk. We'll see you next time.